Welcome to another episode of As the World Turns.
Actually, this is the July the 14th edition of the Jack and Bill Show. I think it's been 2 or 3 weeks since we did one, but we've started the second half of the year. Seems like the first half flew by
Really did.
amazingly quickly, and the market has it'll make a fool out of you sometimes if you let it. It's very interesting to see the leadership of the market that we've had so far this year. You know, Bill, I was looking at this morning. So after these things got hammered last year, it's Amazon, Apple, Alphabet, or Google, Microsoft, Facebook or Meta, Tesla, and NVIDIA. You could throw Broadcom in there. Those names have propelled the Qs to be up 43% year to date, and the S&P 500 up about 18%. And the Dow Jones industrials are only up mid-single digits. So that's kind of been the story of the year. After value had a very good year last year, growth is overtaking value again. Mostly those select names. If you think about this, I heard this statistic. S&P 500 has obviously 500 blue chip names in it. If you take 1% of those names, the biggest 5 market caps, which are all tech stocks, I've just named them, comprise over 25% of the S&P 500.
Yeah.
1% of the names, 25% of the market cap, and that's what's driving it. Now we've had,
and that's what's driving the whole performance of the index, or the performance of the entire index.
Exactly.
So it's kind of misleading. I mean, when you're benchmarking and you use something like the S&P 500 to benchmark your portfolio's performance, you're really benchmarking against the technology sector.
Yeah, this is true. So, and then, this bellwether Dodge & Cox Income Fund is up 3.89% year to date. The bond market started off really strong in the first quarter, but in Q2 we saw longer-term interest rates go up. Of course, we've seen the Fed tighten 10 times in a row, and then we got a pause. This is really going to dictate largely how the second half of the year goes. It's dependent upon what the Fed does, which is dependent upon the data and whether we go into recession or not. But we've had some very encouraging news this week on inflation. It's a little bit mixed. It's core inflation is still a little bit sticky, but when you look at the whole picture, we've had inflation falling, which has had the market rally. The Fed pause. The futures markets are indicating something like a 92% probability that the Fed will tighten 0.25% at the end of this month, and then a very low probability that they tighten at the next meeting. Of course, that's all data dependent, and if that is the case, some people think that it's one more and done. Some are saying, one of the Fed officials this morning saying likely 2 more and done. But all this stuff is going to be data dependent, and if you bank on it, you're likely going to get it wrong. So now we've got earnings season kicked off today with some financials reporting. Market started out well this morning and has really kind of fizzled to be, roughly flat. I thought I'd make one more comment about the bond market before we get into it. So in Q1, the bond market was very strong after just being totally hammered last year. Last year being the year very tough to hide. Stocks down, call it 20%. Bonds down, call it 15%. Long dated bonds down, more than that. This year, we've actually fared much better than, say, an intermediate term stalwart like Dodge and Cox or Jeffrey Gunlock's double line total return fund, which is up. It's up roughly 3% as well. We still like shorter term bonds, even in the lower tier of investment grade. You can capture. We own a short term bond fund, very strong performing, number one in its category for short term bonds out of 532. Has a yield to maturity, and these are short term investment grade bonds. The yield to maturity is roughly 10%. So we like that part of the bond market, which I think these higher rates, given everything the Fed has done, is giving us a real opportunity to bank on some really nice fixed income returns, even in treasuries and the highest quality. But Bill, I'm gonna let you start us off here with our topic of the day.
I'd like to add,
okay,
before we transition.
Yeah.
And we're talking about these results, and we want to also say that there is this seeming AI mania that is moving markets, and that's been going on since the beginning of the year. So it's been a theme, AI, anything and everything, and people are expressing that through mega cap tech names, and that as a result is driving the major indices. So we've seen this big bifurcation between mega cap tech and the rest of the market as we look at indices like the NASDAQ 100 and S&P 500 and compare that to the Dow. And we've also seen the big bifurcation between growth and value. It flipped from last year. So now the question at mid-year, and you brought up earnings, will corporate earnings pass the muster? And that's a big question. There is a lot of concern about lagging effects of the Fed's rate hikes and what that's going to do to corporate profitability. But it's almost like we have to see something happen here. We can't continue with this bifurcation. Either we see the overbought tech sector come back down to earth, or we see the rest of the market catch up. One of the two has to happen.
I would agree with that wholeheartedly. So and so, what do you do with that information?
Well, I think that the danger here is trying to chase returns. When you say, "Hey, the Nasdaq, is up over 40% year to date," that can get people excited. It doesn't excite me. It actually makes me want to do the opposite. I would rather go into those areas that have underperformed and some of just the boring blue chip sectors and wait for another opportunity in technology.
Yeah, you don't have to swim in every pond.
No, not at all.
And I just have a recollection of when I was in the business in the late 90s, and from 1995 to the end of 99 or 2000, we had stocks just go crazy. Of course, we had Y2K there at the end, which turned out to be nothing. But as soon as we get into 2000, the tech bubble bursts after the S&P did compounded return for a 5-year period of 28% per annum, with NASDAQ stocks going up way more than that. And then what happened? We had the NASDAQ composite get over 5,000 on the index, and it went all the way down to 1,550. And that took more than a decade to recoup that.
That's total destruction of capital. And these returns that we're seeing year to date in these growthier sectors, as attractive as they are, they still haven't made up for the losses from last year.
That's exactly right.
And so to the degree that we can kind of smooth out the ride, we're actually better off because we're building upon higher levels. These big drawdowns that we've been witnessing over the last several decades, are enough to wipe out capital permanently for some people, depending upon their age.
Yeah, and with a lot of these NASDAQ markets trading at multiples of PE ratios of, say, over 50, you can find cyclical stocks. I mean, we've owned positions in Ford and Delta, which has been strong this year, but Ford is selling at 10
Single
times
digit.
earnings. Delta's selling at like 7 times earnings. They just reported their best revenue quarter ever, and feel like they've got momentum right now. And the current quarter's likely going to be similar. So, and then dividend paying stocks. AT&T, Verizon, yielding, both of them yielding over 7%. There's quite a few names like that are selling at single-digit multiples with huge dividend yields. And we could see, even with the cyclical stocks that we've named, we could see a recession and still see cyclical stocks outperform growth.
True. I heard someone on Bloomberg TV this morning commenting on the market year to date and how she sees no catalyst for correction. Well, so what? That's often the case. A correction
change
occurs
tomorrow.
Based on a catalyst that no one sees. We're not in the business of identifying catalysts for corrections or up moves, but when we see conditions that are overbought like we're in now, the prudent thing to do would be to take a little bit off the table, because all it takes is for something unforeseen, and those things that are very, very pricey will come back down to earth. And if we do see the recession manifest, or we have whatever it may be coming down the pike that could upset the apple cart, so to speak, it will be these very, very high valued tech names that will get hurt the worst.
Completely agree. So now is a wonderful time, and we'd love to help any of our viewers with this, to rebalance portfolios. Mm-hmm. So if you had appreciation in equities, or some of your equities, high-flying equities that we mentioned, now's a great time to rebalance that back into the bond market, or alternatives to stocks and bonds.
Absolutely.
So, but now we were our custodian. Actually, we have 5 different custodians that we can utilize through our parent company, WealthCare, and the overwhelming majority of our clients custody through the institutional arm of Charles Schwab. Schwab made a recent acquisition of TD Ameritrade. I understand it's possible to still open up a TD account or a Schwab account, but most of these, the conversion has taken place with the completion of this. I just read today in a news story slated for September of this year. And so Bill, why don't you kick us off with what we're going to share regarding all this?
Well, Schwab made this acquisition of TD Ameritrade in November of 2019. So this is 3.5 years running. Oh. And since that announcement, both firms have operated independently. On our side of the business, on the registered investment advisory side, we've always favored using Charles Schwab. TD is terrific too, and they each have their strengths and weaknesses. But those two firms are the number 1 and 2 largest discount brokerages in America, as well as being the number 1 and 2 largest firms that work with independent registered investment advisory firms. In fact, Schwab has about 10,000 independent RIAs that use them for custody, and TD about 8,000 for Schwab, and TD is about 7. Now there is overlap, because there are RIAs that utilize both firms for custody, so they'll probably be left with about 10,000. But it's just created this behemoth, not just in discount brokerage, but in RIA custody. And now this new entity just dwarfs Fidelity and Pershing and other custodians.
They've been instrumental in driving costs lower.
They really have. And, there's been this race to the bottom with commissions, and Schwab cut trading commissions to zero. And that put a lot of pressure on TD Ameritrade. They felt like they had to do something, and what they decided to do was to combine. Now, for our clients, I mean, this is a good thing. I mean, we have all of the resources that we've had available to us through Schwab, but now we have these additional resources that came over or are coming over from TD Ameritrade. And TD Ameritrade has some terrific technology in some areas that is more favorable than what Schwab offers, especially on the trading front and mobile trading. So I'm really looking forward to these new applications, including things like the Think or Swim platform that is very popular, that's offered by TD. Now, for retail investors, do-it-yourselfers that have accounts at TD Ameritrade, you've probably already been notified by now, and there is a process. There's a notification timeline that Schwab is using, and from what I've read, it seems pretty straightforward. Basically, everything is done for you. The only thing that an account holder is required to do is establish a new login. And so for TD Ameritrade account holders, everything comes over, all their securities and assets, all of their trading histories, their account statements, all of that comes over and migrates to Schwab. But you will have to establish a new login. You will have a new account number. For legacy Schwab account holders, I mean, there's nothing changes other than you'll have more capabilities. Now, this is not an important event for our clients, and it may not even be that much of an event for TD Ameritrade retail account holders. But we wanted just to make this announcement and use this as an opportunity to say, this is an opportunity for you to review, and you may want to have a professional like Eagle Financial take a look at what you're doing on your own. You may be ready to hire an investment advisory shop to do the heavy lifting for you. There's nothing wrong with investing on your own. And we have clients here that have some accounts on the side that they manage on their own. But we also see the benefit of having a professional overseeing and managing, especially the larger accounts and what we call the serious money.
Yeah. I just thought of something else. I mean, it's not just about TD, but if you're a do-it-yourselfer, or you have an account, or you have an advisor that you're not happy with, or any type of account anywhere, we'd love to take a look at that, and and it could transfer in just like a TD account could transfer in. And it's interesting that I just thought of this, where we periodically do seminars, and we recently did one, and there were a couple of alternative investments that we own in client accounts that we love right now and have for years, and they have performed spectacularly. One of them is a BDC that yields, pays a monthly income of over 8%, very low standard deviation. They have a new fund, the same company that has one a little bit lower quality that's yielding over 10%, with the earnings yield on both of those funds higher than what they're paying. They should have built-in appreciation. And then we own a multi-asset strategy fund that's managed futures with an MSCI World Index overlay, and then they also have 30% of the portfolio approximately in treasuries, paying 5%. This fund has made compounded well into double digits since inception. And but I thought about this, Bill. Most people can only buy these products through Charles Schwab. You realize that? Have you thought about that? I mean, in other words, these companies that run these alternative investments like the idea of registered investment advisory practices where the portfolio managers are permitted to think on their own and come up with, have the freedom to find things that work well and that, for example, that we feel are suitable for our clients and make a lot of sense. And in these two names, they're only available through the RIA channel. So I would just like to throw that out there. If you're a viewer that would like to learn more about these things, just give us a phone call or ask a question.
And for those of you who have accounts on the retail side of Charles Schwab or TD Ameritrade, even though these funds that we are alluding to are available to us through Schwab/TD, they're not available to you as an individual. They're only available to us as a registered investment advisor. So there's a lot more available to you.
The minimums are typically too high. Yeah,
correct. There's a lot more available to you through us than what you have access to on your own.
Yeah.
So
that's
it.
That's about it. We wanted to keep this brief. It's been a steady, first half of the year. One thing that's for certain is it's not going to be the same for the second half.
Yeah, right.
I mean, change is really the only certainty. But if you'd like to have your portfolio reviewed, or you have a TD account that you'd like some help with,
or a Schwab account you'd like help with, or any of these accounts you'd like help with.
Give us a call, phone call, email. Find us on the Jack and Bill Show or the website. Send us a message. And just wanted to give a shout out to the LSU Tigers for winning the College World Series in spectacular fashion. After getting creamed by Florida, they come back in a winner-take-all Game 3 and pretty much did what Florida did to them, the prior day. Then we just had the draft, and first time in college baseball history that the same program had both the first and second draft picks taken. Paul Skeens at pitcher, followed by Dylan Cruz, the spectacular hitter. And it's going to be interesting to see how they reload for the next season. So preseason football is only a few weeks away. Mm-hmm. So, that's a wrap. Let us know if we can help you with anything. And thank you for watching, and have a great weekend. Be safe.